Nerd alert! Property Nerds, the home for data-driven property investors, where we uncover Australia's hot and cold markets, latest headlines and trends.
G'day everyone, welcome back to another episode of the Property Nerds podcast. I'm your co-host Arjun and joined here by Jack, and we are going to dive into the world of consolidation of portfolios. So you might go, why the hell are these guys jumping into consolidation? Because typically the bias is that someone who runs a property investing company would talk about buying, and then someone who runs a finance company is loans. And so you're like talking to the wrong people here if you're thinking we're going to go through in consolidation, but that's not the case. We are definitely going to focus on the end goal of property investing, because no one really gets into property investing just to buy property. Like, they get into property investing to have an income, have wealth generated, something that supports the growth of their family and their personal journeys. And so why don't more and more people talk about that? And that kind of frustrates me, because everything's about the next place, the next research, the next area, the house that you buy, the deal, the numbers they got, the life changed on the properties purchased. But no one's life actually changes from properties purchased. Life changes when you have no debt on multiple properties and you reveal that there's an income now coming in that's sustainable, doesn't rely on you being on interest-only loans, doesn't rely on you and having a high income. And also there's wealth, there's equity that can be passed on to kids, have a secure future for yourself. That's the name of the game. So enough of talking about the buy side. We're going to talk about the consolidation. And so that's the theme of today's episode. Jack, how are you, mate?
Good,
how have
man.
you been?
Good. No, really good, man. I think what you said, you're spot on. Most customers listening to this, and they've probably had a million chats with different companies, and they're always just talking about buying.
Yeah.
They don't really ask the question on how does this eventually end to me having a retirement, and the people on the other side don't really know. So I think it's good for us to do an episode like this and talk about some different strategies in super, also outside of super, of how it all ends and how to actually get there, because it's 100%. You can't just continuously buy all the way until you're 60, because you'll be working until you're 90. So,
Hey, you never know, mate. You've been doing some intense training of late, mate. You'll be up until 90s, won't you?
Hopefully, mate. Hopefully.
Hey, we never know what injection will come out. I mean, there's some crazy shit going on in the world.
Yeah, no, I know.
I heard there's people living longer by going over to Colombia for some special stem cell injections and getting some special grade stuff. Like,
we're young enough to see all that happen, mate. So we'll see.
All right, fire me up, jab me up. I'm ready for another 30 years. But no, it's a good point, mate, you raised there. And I guess the starting point I should just talk to is when people are building a portfolio and everyone is about buy and keep going, sometimes people oversimplify stuff as well. And like, they just forget that when you're consolidating and trying to grab an income, 100K today is going to be different to 100K in the future.
Yeah.
The silliest ones I've seen out there are like, hey, we'll get you to 150K passive income or 100K passive income. All it takes is 4 properties and you're there.
Yeah.
And then you're like, okay, great. But are those 4 properties that I own debt free? How do I get them debt free?
And they'll say, and it's only in 5 years or 10 years. Like, they're just really trying to sell you on the idea of buying as many properties as you can with us, and then that's it. And then they over promise and under deliver in the long term, but by then you've already gone and bought those 4 properties with them.
Absolutely, mate. And like, this is why at InvestorKit we always talk 20 plus years of planning.
Yeah.
And people go, oh, well, don't plan for 20 years. You don't even know what's up next. Well, bullcrap. Even if you don't know what's next, you need to know that you can't buy every property you need for your future in the next 5 to 10 years and have it consolidated and you're good to go with a sustainable passive income. It just doesn't happen, right?
Yeah.
And so what happens is that you'll need buying time extended. So here's a quick example. If you've got a 20-year goal, you're in your 40s and you're going, in my 60s, I want to be okay in life. Well, firstly, when you're in your 40s going to your 60s, are you going to buy your 5 or 6, 7 properties or 3, 4, 5, whatever the number is for you? Are you going to buy all those properties in 1 year? No. You're likely to spend the first 3 to 7, 5 to 10 maybe, buying those properties. So guess what? On your first property, sure, you've got 20 years. Good stuff. 2 decades of growth, compounding, rents rising, selling an asset, great. The second one is now at 18 years. The third one, maybe at 15 years. But that fifth asset that you got that you think that's going to be the X factor, you only have 8 years to 10 years left of that. So if you've only got 10 years left of that, how do you feel like that's going to change your whole life? Even if it doubles in value in 10 years, 500K place becomes $1 million. Now you go, well, I've still got 400K loan on it. Maybe the loan came down a third because, right, it's a 30-year loan term, came down to 300 or 400. It's still a loan on it. You do the maths on any $1 million place with a 400K loan on it, it's not getting you retirement. Yeah. And so the key thing here is that you need time and you need to consolidate, which moves on to the next part, Jack, is that many people look at getting properties and they don't realize that the same properties you have now are likely not to be the ones that the end goal that get you your passive income.
Yeah,
and me and you believe in this concept called trading up.
Mm-hmm.
We believe in the concept of transitioning and not just being in one type of vehicle the whole time. Could you expand on that a little bit more so people get what we're talking about?
So for starters, before I jump into that, you've got to really understand what you want in life. How long is it going to take you to get to retirement? You know, when do you want to retire? Where do you want to live in retirement? What's the income that you think you'll need to sustain your lifestyle? Once you know those things, your professionals can reverse engineer that and actually.
And is that Thailand for you or Bali?
Thailand.
Yeah, I'm a Thailand guy. So sorry, Bali friends, if you're loving it. It's a great spot. We love it, but Thailand's my spot.
So if you don't really know that and you're going into it kind of, which is fine. Like if you still want to make a start, you're not quite sure, that's fine. But just try to figure out what that end game looks like for you, because it's going to be much easier for you to get there once you know what that is. But if we're touching on a few different strategies within super for starters, I think just to run a few scenarios, say you've got a couple that has 200K in their super, right?
Yeah.
They allocate 150 of that to buy a property worth, say, 600. Now, they've got that 50K buffer there. It's theirs, doing its thing. 10 years later, say conservative, it's worth about 1.1, right? Conservatively, right? Very conservatively.
Yeah.
The debt was the same. The debt might only be about 450 now, right? And if you sell that property for 1.2, there's a pretty heavy capital gains tax discount. And let's say you walk away after costs of about 500K, right?
Yeah.
That 500K, you can split that up into two properties now for 650 or 700, or you could use it for a much bigger deposit on a commercial property. It really depends, but I think at that point you'd still want to allow the fund to grow. You could even go residential all the way till retirement, right? So if you kept doing a similar strategy to that and held it for another 20 years, right? You get those two properties for 600 each, held it for another 20 years, and then in retirement, you were able to sell that with very little debt and a pretty decent capital gains tax discount, if not all of it discounted. That's, $1 million plus $2 million of cash. Now, with that, you could just pay cash for a commercial property at retirement, still in the fund. Now, $2 million of commercial property at 5.5% yield, that's 110K net, right? With no debt, that's one asset.
And I think on that point as well, what you've just shown is like that is the trade up, right? You're going from residential to commercial, from low income to high income. And here's an interesting part. Rents over the last 20 years in residential property have not been outpacing price growth. So if you have a rental yield of 4.5% at the time of purchase gross, before rates, maintenance, vacancy, other taxes, things like that, your growth rates of your property might be 6%. So even though rents are rising, the value's risen much more. So your cash is actually not working as hard as it could be. Yeah. Because your cash is now a high equity or a strength in like asset position, but the yield it produces is actually much smaller than what the value is. Yeah. And so your yield against your purchase price looks phenomenal because the rent you got at purchase time might be $400 a week for a 450K place as an example, or whichever number you want to take. But then at 20 years from now, that rent might be $800, $1,200, $1,600 a week. Brilliant. But that's against the yield on purchase, the 500K purchase you made. Great, looks phenomenal. But if that property is worth $2-3 million now, that yield's not that good. So we love residential property, but at some point you've got to trade up. And I'm going to go out there and even say this. Even if property, as professionals we are here, like, what if you don't go property? You might even go to other vehicles, and that's totally okay. Like, we want to tell you that you want to hunt for income and consolidation phase. And so if you make that decision, you go commercial, cool, great. But if you make that decision and even go managed funds with high dividend yields or high annuities, anything with a financial planner that can come in and they can get your income working for you, like consider that because you've done the heavy lifting. Property's been your baby. It's done that thing for you. But rental growth does not outpace house price growth. So house price growth means it's great at the start to have a good yield, but your yield gets worse over time because the asset value is much higher and the rents don't move at the same pace. So at some point in retirement, it's time to switch up, right?
Yeah.
So that's obviously an SMSF example. Let's talk about the personal side. You've seen a lot of strategies that people consider at that point. What does that look like in terms of the consolidation phase for you?
Yeah, so it's different for people that, because if you're using super, then you can do a lot of heavy lifting there that doesn't require you to do as much heavy lifting in your personal name or outside of super. So if you're going just down the personal name route, then you might have to be a little bit more aggressive if you're not utilizing the super to that same, because that strategy that we just described of going residential, splitting it, going to holding it until you're selling it, and then going one big ticket commercial, a lot of people say, 200K passive income. That strategy there, if you utilize your super, you're halfway there by the time you're retirement, right? And then outside of that, you don't have to do as much heavy lifting to get the 100K outside of that, right? So, and using those two things in unison will get you that 200K passive income. Yeah. Now, if you don't want to do the super route or you've got other plans, you want to diversify, fine. If you go down the personal name route, obviously there's going to be an accumulation phase of you getting residential properties, having exposure to capital growth, leveraging that, building more and more. At a certain point though, you might hit your capacity or you might just go through a phase of holding, which there's nothing wrong with that. At a certain point, people make the mistake of saying, oh my God, I'm tapped out. What do? I have to buy. And they go and buy 100K, 200K properties in mining towns.
Just to get in the game, and it's not the right way.
Complete FOMO energy, there's other ways, focus on paying off your owner occupied property, right? Being debt free on your owner occupied property over time is a really good step towards that financial freedom goal, because
Absolutely.
Then that you've got investment debt, but you're debt free on your house, so your borrowing power is going to be way better once you do that.
Correct, because you can leverage against that home in the future should you wish to grow that portfolio further, and the debt's now tax deductible.
That's right.
And the bank considers that debt to have a better borrowing capacity because you can actually use it for investing purposes. They apply negative gearing, right?
That's right.
What you just touched on then is showing you that the next deal isn't always the right deal.
That's right. Yeah.
You've got your home and you can lock in on paying that down if you've achieved your portfolio acquisition goals, because it's consolidation from here on out.
Yeah.
And to your point, when you're thinking of the numbers too, everyone tuning in, 100K today actually might be 170K you got to hit in the future.
Yeah.
So whenever you're aiming for a goal, don't just do the lazy number and go, I'd love to have 100K passive, or I'd love to have 150 or 200. Go whatever it is today, work on inflation calculations. And that's something we do. So at InvestorKit, we actually have discovery calls that turn into strategy calls. So once you've come on board as a client, the first thing we do is build out a portfolio plan. And in that portfolio plan, we reverse engineer the next 20, 15 years from a property perspective. And in that property perspective, we're able to see, okay, you have a goal of 150. Well, maybe that's now 230K as a goal or 240 as a goal, because you can't look at 150 the same. That 160 in the future and 20 years from now might be 100K today. So I think that's an important one to consider when you're consolidating, is that you need to aim for a bigger number, which actually means the next point. Jack, you touched on the point of being aggressive. And the point of being aggressive is so important, because if we have a 20-year buying window, we need to roll that buying down to 5 years even.
Yeah.
So you have the whole 15-year cycle ahead.
Yeah.
And when you're doing that, you need to make sure that you're not just looking at 4 investments that get you the income, because how do you get the 4 debt free? And so this is when you need to go, well, maybe I need to get to that 5th or 6th one so I can have 2 extra to sell.
That's right. Yeah.
When people start getting to that point of where they really need some of that extra borrowing capacity and they didn't think of that, they just thought, wow, I got my 4th, I'm good. And they're like, oh, I only got 15 years left to pay off 4 loans. What are some of those X factors you see in borrowing capacity world that you go, okay, here's how we get that 5th and the 6th?
Yeah, so you could, once you've accumulated those initial foundational properties, if you want to push further and you really want to go on that journey of buying multiple properties, that's when you can start to look at buying in trusts. Now, you can go a long way with a trust, with a corporate trustee, but if you really want to utilize it to its fullest, it involves multiple trusts, right? Because when you're buying within a trust, the whole point of that is to one day that trust is going to be self-sufficient, and the debt within there is going to be able to be excluded once it is self-sufficient. Because although you might have a property that you own personally, that the rent covers the interest-only repayments. But when a lender's looking at your ability to, they're looking at that loan, they're putting it on buffers, rental income buffers, assessment rate buffers. So although it's positive for you, when the bank's assessing it, it's not positive for them, right? It's not. But when it's in a trust, if it's positive within the trust and the accountant can write you a letter stating that it is, then that's how you can really scale. And once you've got a property that's in a trust that's self-sufficient, you don't want to add another property to that to kind of ruin that self-sufficiency, because it does take some time before you to make it positive again. So when it is positive, then you can set up a new trust and buy a property within that, still disclosing the properties in your personal name, but getting an accountant's letter for the first one. And you can kind of just rinse and repeat that until you hit a point where you're like, I'm happy now. But doing that allows you to push forward, but it allows you to push forward without having to go too crazy with third-tier lenders, right? It's kind of a way to still get major bank funds without having to go to these third-tier lenders and be stuck on these really high interest rate loans. So
yeah, that's actually something we should actually dive into, a bit of a working example. So I'll just shout out what people should really take from what you've said there. Imagine you've got a goal of getting 4 properties debt-free, and you feel that getting to 6, you clear 2, gets the 4 debt-free. If you had 2 in your personal name, these are higher valued assets. And from the 2 in your personal name, they're going to be the ones that maybe are higher purchase prices. At InvestorKit, we call them anchor assets or foundational properties. These larger purchase prices are in major regional centers or major capital cities, and they're a way for you to get like a bigger base. Now, these properties don't typically positive gear very quickly because they're larger values, and then the rental yields drop down a bit. But if you have them in your personal names, the gearing deductions from negative gearing will support you from a borrowing capacity, will reduce that cash flow loss. But then the second part is, as the equity grows, you'll have many more lenders you can take equity out of. Now you go, well, the bank's only letting me borrow for 4 in total. So you got 2 already. This is when you might set up a family trust for your 2 next investment properties that are affordable investment properties with good rental yields in growth markets. Yep. They, over time, reach self-serviceability. Now, that could be 3, 5, 7 years, depending on various factors. Rents rising, yields on purchase price, the interest rates coming down, how much money in offset, all that sort of stuff.
That's right.
Now you go, well, I set up a second family trust because I've still maxed at the 4, the 2 personally, the 2 in that trust. And if that first family trust has the self-serviceability, that first family trust has excluded liabilities. And so now the bank will only see and care about your 2 personal and the next 2 you're buying. And you've now achieved 6 properties, right? And then it's about looking at the best 2 performing ones, and it might be in trusts or it might be in your personal names because of the large value, low yielding ones.
Yep.
And you might sell those 2 large value, low yielding ones, clear the debts in some of these trusts, and there's suddenly positive cash flow. So that's essentially the working example of what Jack's just gone through. But the other thing we might jump into, it's one of my favorite ones, it's the downsize. The downsize of a family home is by far the most powerful consolidation tool in property investing. So the downsize of a family home is the most powerful tool to wipe debt and get to a consolidated portfolio. Now, let me give you a working example again. If you've got a $1 million family home, and let's just use the 2 decades principle, and let's just, for simple numbers, the doubling over each decade. Not a perfect number. Doubling is usually 12 to 15 years, but we'll call it 10 for this example. 1 becomes 2, and 2 becomes 4. So now you've got $4 million of assets, but usually in a family home, over 20 years, you're not just going to sit there in interest only. You're going to be paying it down principal and interest. So that $800K debt you had against it's probably 2/3 down, and you're left at likely $200 to $300K of debt by the time the 20 years is over. Let's just use $300K as an example here. Now, $300K, when you've got that debt, that $4 million value, if you're selling that home, firstly, in today's tax laws, that family home is debt-free. You bought it in a personal name, you lived in it, you meet all the requirements of it being a principal place of residence, you've sold it for 4 million. Let's take away, 100K in costs, right? Let's take away the loan that you've got of 300, and you're down to about 3.6 million in cash. And for simple numbers, we'll round down to 3.5. If that's a 3-bed, 2-bath or a 4-bed, 2-bath in the burbs family home and you downsize to a unit, firstly, units of the last 40 years in Australia have underperformed houses. So that's actually good for you as a downsizer. Yeah. You're now purchasing a unit maybe at 1.5 mil, and suddenly you've got 2 mil cash. And that 2 mil cash could go in your offsets across your 4 investment properties with 500K loans still on them, maybe interest only, that are still sitting there, and you've now fully offset all your investment properties. So that can be one of the biggest X factors. So just to summarize, we've got 3 key consolidators. And Jack, if you've got anything else, chime in. One is the downsize of a family home. Second is trading up assets to higher income vehicles, both in super and outside, so commercial property or non-property investments. The third is extending servicing out to buy subsequent properties to then exit those properties at later times and then clear debts as well. But that's in the scenario if you don't have that larger family home just yet. Those are the 3 core things. And the final 2 points that we shared was it's not all about the buy. It's actually about the consolidate. And you need a good 20 years as part of a solid plan to get there. And the second part is condense your buying. If you've got 20 years to get to a goal, try buying 5, right? If you buy beyond 5, everything's working against you with the number of debt, unless you're willing and able to sell all those extra ones you got. Yeah. That's my 5 core takeouts. Anything you want to chime into there?
For sure, man. So, downsizing the family home, you don't really think about that when you're filling up the bedrooms, right?
Yeah, it's emotional.
You're in your 30s, you're filling up the bedrooms, you've got all these kids going around, and then you hit the 50s and it's like, they're all leaving.
Unless you're an Indian family like mine, man. We stick around like, I'm gonna be 40 something and I'm gonna have like parents and stuff around us. That's the way we roll.
It happened to my parents, man. Like they had a 5-bedroom house, and then all my brothers moved out, and then I moved out, and they don't need it. You get a bit older and you're like, I don't need to be cleaning a 5-bedroom house. And they did the exact same thing, right? They downsized to a unit. Hopefully that's a unit with a view for 1.5 mil. Let's hope so. But that gives you a lot of options, right? Once you do that, because you're right, you can sell it without paying capital gains tax. And once you downsize, you've got all that cash. You could either keep that as a buffer. You can use it to pay down debt. You can use it to buy a commercial property in cash, right? So it's really powerful, man. And just touching on the exit strategy as part of that, but also another exit strategy when you have doing it in your personal name or in other trusts. When you get to a point in your portfolio when you've got the means, or you've got the capital and the means from a borrowing capacity standpoint, or you've just purely got the capital injection from your existing properties, selling one or an inheritance or something like that, if you have a passive income goal in mind, right, and you've now got the means to sell off something and buy a high value commercial property in a trust that, from a net yield perspective, assuming it had no debt, was that income figure. So say, for example, $1-2 million asset today, commercial property, 5.5% yield, conservative, is $110,000, right? Although you might have to acquire that with debt, that rental income figure is going to increase as you're paying it off. And by the time it is paid off, that might be your full goal from a cash flow perspective, or half of it. So just try to think about when you have accumulated a lot of properties and you're starting to think about that exit strategy, you don't have to delay it as much as you think if you've already got the means to get the asset that's going to be in time give you that passive income goal. So
I love that, because you're not waiting to buy something that actually costs more in the future too. Yeah. Right? Because you're playing catch up. You're actually going, well, I've got my residentials for my growth, for my equity, and they'll give me options in the future. But why wait till the future? If I can buy that $2 million commercial now, whack it in a family trust for tax effectiveness if that vehicle suits. And then all of a sudden, you're now firstly got the servicing. You're almost using that now for all strategies that we just mentioned, right? Yeah. You've got it as a brought forward strategy. Yeah. So that's rent growing. You're not buying it at a future point. Secondly, your residential can consolidate to pay that off. Yep. But the third, if you're utilizing the trust, you've now got that commercial there. And if you can pull up the deposits and maintain serviceability from the deposit pulling, you've got further borrowing capacity for more commercials and other trusts. Yep. And it's almost like you're going through this transition from equity building to income. Yes. Which to wrap up on that point, I might add one thing. Business owners, if you're listening to this podcast, Both of us here, Jack and I, we're in that space of business owning, right? And so we know that the power of when you grow a portfolio is that you're going to be able to have your deposits built from profit over time. You're going to be able to have that fast tracked. If you're looking at a vehicle, commercial property as a vehicle allows you to get this servicing exclusion through family trusts, multiple commercial vehicles, and all you've got to come up with is that constant deposit each time. And in your space in business, that is a strength that you have that many don't have. And so as a result, when you are looking at you've built the asset base of residential, don't spend too much time there. Transition over to commercial because the length of your serviceability extends far more. You're building your consolidation vehicles from the get-go. And the moment that time's right, whether it's a family downsize or selling that first batch of residential properties, you're going to wipe out your debts and you're going to be in a position to actually draw upon that income in the highest income earning vehicle possible. That's something Jack and I do day to day. So if you love this episode in terms of us talking about the other side of property investing, not the buying and the red numbers and the debts and all the things you don't want to see in property, just jump on to investorkit.com.au where we can have a free consultation with our team. We work closely with Jack's team, so we'll work together on that finance element and property element, and we can take it from there to actually not only just buy, but buy with the end in mind. That's the big X factor and the difference maker here. Something we love focusing on is the end in mind. We'll reverse engineer it and hope this episode gave you a few ways of how to reverse engineer it. So it's not just a dream, it's not just a goal, it's actual reality. That's it from us on the Property Nerds. And as you know, with the time this episode's coming out, it's likely Christmas or nearabouts Christmas. So we hope you enjoy a great break with family and loved ones and catch you soon on the next episode.
Game over.